Hello, everyone. Welcome to our last Facebook Live event for 2018. My name is Stanley, uh, and today we have a very, very special guest. He's a good friend, and I have been following his stuff for many, many years. He is none other than Mr. Alvin Chow, the CEO now of Dr. Wealth, and he is one of the key champion of what we call factor-based investing in Singapore. And it is an approach that I'm still learning also, where we have a chat just now learning about what it's all about. He will spend some time talking about that. And but before that, I would just want to maybe introduce Alvin and ask him about how he come about becoming an investor. So hello, welcome Alvin.
Hi, thanks Stanley for having me. Thanks
Yeah.
Gavin that here.
Hey, yes. Before we dive right into the topic of today, right? Just introduce yourself a little bit. I remember I was following you since your day in Big Fat Purse. Some of them might not know, but maybe introduce a little bit. How did you get started in this space?
Okay. I actually started to be interested in investing in my university days. Year three to be specific. So I was studying mechanical engineering. But it was funny that I eventually found more interest in finance and investing. I don't know how that came about, but that was how I first got into it. And it was 2007.
Ah,
It was the last crazy bull run, if you guys remember. And it was so easy to make money. Probably that was the reason why. I still remember I bought like a warrant. That was like the first thing that I bought instead of
wow.
I bought a warrant. That was because warrant is leverage, right? So I could use very little money to buy stocks at a bigger value, right? That
Right.
was I still remember I bought the uh, Costco Corp warrant, and within 1 week I doubled my money. Yeah,
Wow. Very smart.
so I
Very
stopped
smart.
so I stopped going to lectures. And then after that, the next 1 month I started to lose money. Then I didn't find any fun to it, right? So I guess it was beginner's luck lah. But that gave me some interest to continue and to learn more about markets. Then I realized there are a lot of things I don't know at that point in time, and was lucky that I didn't really get caught in the bear market in 2008.
Oh, okay.
Yeah, that was also around the same time that I started Big Fat Purse,
Mm-hmm.
right, as a blog to really write down my journey, what I learned about investing. So it was really more personal than making it public lah. Just since blogging was like getting more popular, I just write it lah. Whether
Mm.
anybody read about it doesn't matter, right?
Okay.
Yeah, so that
Okay.
was how I got started. And then I went to work for 6 years. Then before I decided to make this a business to
Mm.
provide financial education to the public.
Mm.
And that was how it happens in 2014, right?
Oh, okay. Okay.
That
So,
was where education started.
right. Okay. Yeah. You mentioned that you were working, I believe, in the SAF after your university. But at that time, you were already blogging, right?
Yeah.
During your work. Okay. But what makes you, after you decided to quit from your job, what makes you decide to jump into this industry in particular?
Uh, as I mentioned, it was a passion or a thing that I really enjoyed. In fact, there are a lot of hobbies in the past that I had, bicycle, all this kind of thing,
Uh,
just came and go. But this is something that stuck around for a long time. So that
okay.
probably this is the real love, lah, right? So I
Right.
decided to get married with this.
Ah,
Yeah, so I was thinking about my career and what I wanted to do. So I asked myself a very simple question: would I regret not doing it
okay.
20,
Interesting.
30 years down the road? Then my answer was yes. So then it made that decision a lot easier. So that's why I left and started this company. Yeah,
Cool.
and along the way, we did an acquisition on Dr. Wealth,
Mm-hmm.
and that was around 2 years ago. And we cannot have two names, right? So we decided to choose one that sounds more professional,
All right.
less casual as the other one. Yeah, but at the end of the day, it was just a choice. Like, it wasn't really a deliberate kind of discussion among the shareholders, etc.
Right, I see. Okay, no problem. I think more people are joining in now. Hello, JJ, and I think my colleague Willie is listening in as well. So if you have any question for Alvin during this time, we're gonna discuss about what he thinks of the 2018 market and also what he looks at 2019. If you have any question for him, just type it in the discussion box below, and I'll try to get all of them answered if possible. But before that, you are one of the person that's actively promoting what we call factor-based investing. What exactly is factor-based investing? Because it is also something that I to be honest, I am not very familiar with as well.
It's actually in one of the, I believe it was in one of the chapters of CFA program, but it's fine.
Oops.
Okay.
Clearly, that section I failed.
Right. This factor-based investing wasn't invented by me. It actually came from the academia, the finance and economics professor based in the US. So the most important year probably you should remember was 1992. That's where two professor, Eugene Farmer and Kenneth French, right, from the Chicago School of Business, they started to really trying to find out, right, what really works in the market, the stock market, right, what really gives you high returns and what really not. So they're trying to disprove investment metrics. That's in general the essence of it.
Right.
And of course, they don't just start from anywhere, right? They just look at the stock market and see who are already the successful investors. And of course, Warren Buffett is one of them. And you can trace all the way back to Benjamin Graham in 1934. And also, maybe a lot of people don't know, but Benjamin Graham has a lot of successful disciples, right? Like your Walter Schloss, Irving Kahn, just that, of course, Warren Buffett is the best of the class.
Yep.
So they started to see, is it because they are just really lucky? They were born in the right time, or no? Or is there really a secret sauce to their methodology? So that's where they started to dig out the key metrics that they use.
Right.
One of it is price to book ratio, a very classic value investing strategy.
Okay.
And they also realized that some of them tend to buy the smaller cap stocks.
Okay.
Right? So then they started to test, okay, let me use data, financial data, and let's say you form a portfolio of 10 different portfolios of stocks, right? And you form them by grouping them into their various degree of price to book ratio. Okay.
Right.
And let's say you buy the cheapest group, which is the lowest price to book ratio versus the higher ones.
Right.
What they found was that the cheapest group of stock, defined by the lowest price to book ratio, actually delivers higher return than any other groups that had higher price to book ratio. So that in the essence, they prove that just by quantitatively, they are even stock name blind. They just form this portfolio based on just this one metric. They found that you can just deliver high returns.
Right.
And that was the same for the small cap universe. They found that smaller cap stocks tend to deliver higher returns than bigger cap stocks.
Right.
So in that 1992 paper, they kickstarted this factor-based investing. It got a lot more of the attention in academia, and they started to research other things. What other metrics or other factors may work in the stock market? So things like profitability, higher profitable stocks delivers higher return than lower profitable stocks. This one is no-brainer, right? But the characteristics are very different from deep value stocks, right? Because highly profitable stocks unlikely sell you very cheap.
Yep.
And cheap stocks are unlikely very profitable.
Right. Okay.
So, but even if you buy the very cheap one or you buy the very profitable one, either one, right, will still give you decent high returns.
Okay.
Yeah. So they started to find more and more such factors, and that's why it's called the whole movement or whole campaign is called factor-based investing.
I see. Okay. Now, it's all coming back now. I remember should be from level 2 of the CFA course. Okay, but from what you discussed, right? Because it's not just one style of investing; it's a combination of style. So should an investor just focus on maybe one niche of it, or from your opinion, you should have a holistic approach, so they should have stocks within each different factors, so to say. So how do you construct your portfolio?
So it's yes and no, right? Let's start with the simpler explanation first. So yes, in the sense that any investor, right, can just focus on one factor. Let's say you prefer the value factor and you want to build a portfolio of value stocks, it's fine, right? Or you want to build a portfolio of profitable stocks, it's also fine. Okay. The only good thing is that if you go from a factor-based approach, at least you know that the metric is proven, and statistically, if you use this, right, you have an advantage over the rest.
Right.
So at least it's not blindly just roll out your investment strategy. So I think that's not a bad thing. The only downside is that we all know value don't work every single year. There'll be some years that value don't work as well as profitability, and vice versa. Profitability also doesn't work every year. So the new belief is that besides just doing asset allocation like your stock, bonds, commodities, etc., even in stocks itself, right, you can also diversify by factors.
Right. Okay.
Right. So you have like value and profitability, these two very distinct kind of stocks in your portfolio, and you put them together, your overall portfolio returns will smooth out.
Right.
Because one work better than the other at
Okay.
different periods of time.
I see. Okay. Can you share one myth I think a lot of investors tend to assume is the case, but you mentioned to me just now one particular case I find it very, very interesting from the research on that paper that actually that factor doesn't prove to be high return. Can you share a little bit about that?
Yeah, a lot of investors prefer stocks that have high ROE, return on equity, or even high ROA, return on assets.
Right. Okay.
This either one, right? But research have found that they don't really give you extra returns over to the indices, right, for the same period. Okay, so that's why I prefer this kind of using this kind of research, because it's a lot more objective and it's proven by somebody done the proving, right? I don't need to do it with my own money. So, so that's why I would rather like stand on the shoulders of giants and just apply what I've learned.
Right.
So there are a few explanations. So the funny thing about factor-based investing is that there are many explanations. Okay. I will prefer usually from the behavioral finance point of view of explanation, but again, because the market is so complex, nobody can really find out the causation, right?
Yep.
One of the explanation is that high ROE stock tends to attract competition.
Okay.
Because if, let's say this industry, while you're really milking it, right, you're making a lot of money, you actually attract attention of other people going in, and then when you have more competitors, you probably have to be a lot more price competitive, and that's where your returns may drop.
I see. Okay.
So from that point, and of course, Warren Buffett came out with those idea, competitive advantage. I want an economic moat, right, that will surround this, that other people cannot take away. Yes. So in fact, there are outliers. I can't remember where I got the statistics, but there are about 4% of these high ROE stocks, right? Okay, will not be destroyed by competitors.
Only 4%.
Yeah, so the odds of it is very, very low. So that's why if you really want to defy that odds, right, you have to do a lot of work.
I see. Okay.
And that's probably why Warren Buffett concentrates his portfolio, because it's so hard to find, and you find one, you better put a lot inside. Right?
I blame it on Buffett because he's the one that advocate high ROE.
I don't know lah. I think maybe he's not explicit to say that lah, but probably he's referring to the universe of that 4%. He's able to identify, right?
Yeah. His mind certainly work different from us. Okay, more and more people is joining in. Hello, David. Hello, Mike, Karina. Wow. Okay. Gary is asking if there's going to be transcript for this Facebook Live. Yes, but please give us some time because we need to spend some time to write down all the words, so it will take some time. I hope you can join us throughout the full session of this Facebook Live. Let's dive right into what our main topic for today. Right? Before we talk about 2019, how has the year been for you, 2018?
Down, the portfolio is down.
What is the some of the, I guess, what's the main concern that you're seeing? Maybe even for your own portfolio, is there real concern that you have or what's happening? How do you see this year?
Psychologically, I always prepared myself that I may need to hold through the crash, right? Hold my stocks through the crash. I know there are a lot of investors who are very fearful of the crashes, and that's why they always try to find out are there any indicators to tell us whether the market is crashing so that we can sell the stocks and stay in cash? But I think it is very difficult.
Yep.
Right. And there's also a price for mistiming. Okay. For example, I hear people talk about, oh, the stock market is crashing since 5 years ago. And you probably have lost out a lot of gains.
Yeah.
Even though the portfolio is down this year, we are still positive over the past 5 years.
Yes.
So you have made money, right? If you just stay invested. So I think mistiming is also a very heavy price to pay. So that's why, yes, it doesn't feel good for the portfolio to go down, right? But I don't believe that I can sell everything before the crash. So with that, I actually be a lot more psychological stable. Say that, yeah, it's fine. Market is like that, right?
Okay.
But we don't need to respond to it and have knee-jerk reactions just because we don't feel good.
Yeah. Cool. That's very similar to my thoughts. I realized that every time I try to time the market, every time I'll be wrong. so I'd rather not time
Maybe
the
we are just bad timers.
Yes, true also because I have been thinking that the market is expensive for the past 3 years already. But luckily I stay invested as well. But looking at 2019, right, I think a lot of market has actually declined, especially the Hong Kong market and the Singapore market now with one of the lowest valuation around Asia Pacific. What are you looking for in 2019? Which industry in particular that you really see at opportunity right now?
Okay. First of all, I think Asia has been very bad for the last few years. Yeah, and because personally I also invest heavily in Asia relatively to the United States, so it's very normal to look like a fool for the past few years, right? Because the Asian market is doing very badly, and I also agree with you that Hong Kong and Singapore are cheap, and in particular, I think Hong Kong is very, very cheap, and in fact, more than half of my portfolio is in Hong Kong itself. But that doesn't mean that there's no gems here. There are still quite a number, right? In terms of the sector that I believed in during 19, right? I think I cannot answer that question properly because it's due to the methodology that I use, which is factor-based investing, right? So based on different factors, right, you'll give us different kind of sectors.
Right. Okay.
And there's the other beauty that you will diversify naturally to different sectors.
Okay.
So I don't do sector picking. That this sector is going to turn around. Maybe I look at some stocks that no. I usually go by factors. Right.
Okay.
So for example, value will tend to give you like property stocks, cash-rich stocks, right? Then your profitability factor will give you more asset-like kind of companies, tech company, education, F&B. Right. So I tend to approach with a diversified sector kind of exposure. Just in case because I don't want to just weigh into one and then got it wrong.
Right. Yeah. Okay. That's fascinating. Then on a follow-up question, if you are looking at mostly of the factor that criteria that you're looking at, how do you decide on your portfolio allocation? Is it based on one factor or is it based on the company itself?
It's actually there's two levels. So you're right at both levels.
Okay.
So the first level is at the factor diversification, right? That will be a bit tricky. Okay. Why I say that is because of course the best is half. Let's say you're gonna do value half, then profitability half. Then it become very balanced. Right. But of course in the real world it may not be so nice and tidy and orderly, right? So for example, it's a lot easier to find value stocks than profitable stocks. Okay, so naturally your value factor will tend to be a larger exposure compared to the profitability factor. So that's one. And then at the second level, right, at the stock level, I tend to put more money into a profitable stock and less money into a value stock. So in other words, my value side is more diversified, whereas my profitable side is a lot more concentrated. Yeah, and it's also because for profitability, as I said, you find less stocks. Right, naturally you have to concentrate more.
I see. So you're saying most of the stocks on the stock market is not profitable.
I'm not saying not profitable. Doesn't warrant the definition of profitable from the factor point of view.
Okay. Cool. Great. That's interesting. maybe I just take a short break because I just want everyone to know that this show is actually sponsored by our sponsor FSN1, which is one of the lowest cost brokerage in Singapore. We try to find partners that we can work together for a longer time. And one of the key questions I always get is which broker I should use. And we have really searched in Singapore for a long time, and FSN1 is really one of the ones that is able to give us a good interface to trade, but also offers a good value and very transparent in their pricing. So if you're looking for one brokers that you to start out with, do check out fsn1.com for them, right?
I use FSN1 for my son.
Very good. Yes. They actually have a account that you can start it as a beneficiary, right, for your son, but you can control it for a while.
So I have it under my name.
So you can so you
Why
can
is it funny?
so you can change your decision next time, right, if it's not nice to you.
Yeah.
Yeah. Good idea. Okay. Look at 2019, right? Okay. Let's go down to the specific. Of course, you guys, if you have any question, also do comment down below. One question that I have previously when we sent out the email to everyone, the invitation is from BL. I think he's one of your followers, maybe, because he asked, he's basically saying that you have been, Alvin has been a great promoter of the ETF, using ETF, and he just want to understand, do you see the risk of ETF, like because some ETF they need market makers to make sure that they have enough liquidity. Do you see these market makers as a risk? Do you know how can we be sure that they will always be there when we need the liquidity?
My understanding about market makers, right, is that they are usually hired by the issuers.
Yep.
So you're right. If the liquidity is low, definitely you need the market makers to hold inventories of the units to be in the buy and the sell side when an investors need to complete the transaction. So I don't think that the risk of market maker, or should I say, I don't think the risk is at the market maker.
Okay.
I do
where's the
think
risk
that if ETFs become like the dominant investment vehicle, right, it might become risky.
Okay. Why?
So for example, in Singapore, I don't think we see that problem now, or even in US, yes, it's increasingly getting riskier in the sense that a lot of money are moving away from active management to passive ETFs,
Yep.
right? The US, right? Hedge funds are losing AUM, ETFs are getting the AUMs, and the problem is that ETFs are like very rule-based kind of investments. So for example, if let's say it's an S&P 500 ETF, the manager is only mandated to buy S&P 500 ETFs.
Yep.
S&P 500 companies, right, to get exposure. So if they become too large, right, they became the one that pushes the S&P 500 index up.
Yep.
Correct? And then when people see, hey, wow, so easy to make money, then they plow more money into the S&P 500 ETF.
Yep.
And then the manager will blindly buy the 500 companies, the same exactly 500 companies.
Yep.
But there are thousands of stocks in the US. Okay, but this 500 will get attention over and over again, and that pushes up the index further. Yeah. So that is that risk that I'm talking about, because if that is a virtuous cycle, the reverse will be a vicious cycle. When people pull money out, the index will fall faster. And the most feared consequence, right, is that stock market crash, right, might be larger than it would have been without the ETFs.
Yes.
So that's my view. But at this point in time, I don't think we are at that stage yet that ETFs are the controlling the market. I don't think so.
I actually have the exact same view as you. I think that that's really a key risk for ETF, because ETF is almost, when they say passive investing, is almost investing blindly, right? You don't even know what's inside, and everyone is just plowing in because it's looked like the simplest way to do it. And when the trend reverse, everyone will also rush up at the same time. Especially ETF is so liquid now, as in the US market. Cool. Okay, for 2019, let's drum roll. What's the, maybe you want to share one stock with us today? What's the one stock that you will share with us today?
Okay. The family is actually lately in the news quite often. The Riyadi family.
Okay.
First Street, a lot of people are complaining, right? That's because the James Riyadi was probed for corruption charges in Indonesia, right? Regarding one of the major project Mekata, I think, right? Bribery of local officials to build that project,
Right.
and that sends off shockwaves to a lot of the reality controlled kind of stocks, right? All their lipo stocks in Indonesia, even some of the stocks that are listed here, like your first REIT, we have exposure to Indonesia, like Lipo Mall, right? Exposure to Indonesia. All those stocks were beaten down,
Yep.
right? Even their bonds as well. Some of their
Yeah.
Lipo bonds here also were whacked down.
Yep.
And the stock that I'm talking about is actually also belong to the Riadi family, which is OUE.
Right.
It's
Okay.
the property counter. Got smacked down pretty bad even before the news. The is devalued in the sense that they're selling very good properties at probably half the price,
Okay.
half their valuations, right?
Okay.
And they own about 60+% of OUE commercial REIT, 30+% of OUE hospitality trust, right? And the downside is that they are slightly more geared than the rest of the property counters, and probably that's the reason why maybe some of the investors shun them
Right.
in fear of the rate hikes, that they need to have a higher debt burden that they're going to pay. But that said, I think that it doesn't warrant that kind of price, right? I think their NAV is probably close to $4. Their share price now is about 150.
Oh, okay.
Yeah, and over 70% of their assets are in properties, and your properties are like your CBD areas, your OE Bayfront, your the downtown,
Wow.
right? OE downtown, US Bank Tower, some Lipo Plaza in Shanghai. So they are very premium kind of properties, and they're selling you very deep
Right.
prices now.
Okay. Wow. Okay.
Then some people may say, hey, yeah, it's cheap, right? But a lot of other property condo was very cheap. Relatively, it's cheaper, okay? But that's not the point, right? So some people will be worried that, hey, they can stay cheap for a long time, right? Then how are we going to
Yeah.
unlock?
What's the catalyst here?
Yeah, so in fact, the analysts have met with the management, I think 1-2 months ago, and there are some, not one, but a few potential catalysts that may unlock the value, right? One is that they are in negotiation to sell the US land tower, US Bank Tower,
US Bank
right?
Tower. Okay.
They bought it like 300+ million. Asset enhancement around 50 million. They're going to sell it around 650 million. Okay, and that would unlock a good part of that assets value, right? So that's already in talks. So they say that it should finalize in Jan, which is next month.
Right. Okay.
Right? So that's one big catalyst. Second catalyst is that.
Sorry, on that first catalyst, did they already mention that they're gonna use that proceed to say like pay down debt or give a special dividend?
A special dividend.
Right. Okay. Cool.
Yeah.
Okay.
But that was a speculation for analysts lah. I
Right.
think the management didn't promise lah.
Okay. Okay. Yep.
Yeah, recently they just sold the downtown to OU downtown to their OU Com REIT.
Yep.
Right. So
Yep.
they free up some cash over there as well. They did a rights issue for Com REIT. Right. They are doing a lot of restructuring in that Riadi empire, and it's clear to me that OUE is like their centerpiece.
Yes.
Their chess master, right?
Yep.
So which means they will definitely make that look a lot better than the rest or the rest, right? So that's why I think that is the stock that I think is interesting, and there are near-term catalysts that's coming. So another catalyst is that that OU downtown also have a hospitality section. I think it's a service apartment, if I'm not wrong.
Yep.
But also approved for short-term stay, so I'm not sure whether they're going to turn it to hotel. Right. That could also be sold to OUH Trust, and they also recycle the capital again. So I think in the next year, with all these things being sold, the company will deliver.
Right.
The debt will come down to a more manageable level. And the last one, there's another catalyst that the management also mentioned, because they also bought Bowsprit, which is the manager for First REIT.
Yep.
Right. And we know that this kind of AUM, property AUM management kind of business is very good. Just take a look at ARA Asset Management, right? So it's that kind of idea. They might list that.
Right. Okay.
They might spin it off,
Okay.
right? and that would have more cash coming back to OUA again. They didn't say it's bounce rate, but I'm guessing that it's bounce rate because they
Right.
did say a fund management platform. So they're at least
Okay.
around 3-4 mil.
I see. Oh,
So
okay.
I think there are quite a number of catalysts that's coming up, and maybe because of all these probes and issues, right, they might want to move even faster to make sure that Empire got protected. Because OUE is run by Stephen Riady, it's not James Riady, it's his brother, right? So maybe they want to make it cleaner forward. So I think the math is good for the share price because it's probably priced in, and then with all these catalysts coming up, things might turn rosier next year.
Okay. Interesting. Okay, but when you talk about this, I think you mentioned just now their NAV, they're trading roughly less than 0.4 times their NAV. But this company, is most of their business still coming from asset ownership or more from the development business?
Actually more from the investment properties.
Oh, okay.
That's a big chunk of their assets.
Okay.
They derive most of the development side. I don't think they have much now after Twin Peaks. And it's always very lumpy, right?
Yep.
So my view is always that focus on the core, which is the investment properties rental. That's more baseline recurring. Then just treat as the development properties as some bonus revenue, bonus profits. That's how I usually say. So I usually discount the development properties.
Okay. Oh, you usually discount the
I only look at the core investment properties.
Right. Okay. When you talk about the company being a bit highly geared, but you see that they have plans to reduce that down, following some of their demerger and also spin off. But when you compare it, I was going to ask, when you compare it with some of the other also high quality property companies, say like Hong Kong Land, also trading roughly I think 0.4, 0.5 of NAV. When you choose this kind of deep value stocks, would you rather just buy the bulk of them, or you still prefer to just stick to one OUE?
I think it's not wrong to just buy all of them. Because you never know who is going to have the catalyst, right? If you know for sure means, and you buy it, means it's insider trading.
Just buy one.
Then it becomes so suspicious, right? So everything, and then you just buy one, right? And then the news pop out, right? So that's the thing about value. As I said, value I tend to be more diversified. So I would tend to spread a bit more around different value stocks rather than focus on one, because you might just be wrong. The catalyst happen in another stock rather than this. So you're right. Hong Kong Land is also pretty much undervalued. But relatively, I would think that OU will have more catalysts coming up. Hong Kong Land has been very stable for a long time. Very, very long time. Likewise for UOL as well, right? Pretty stable. Unless they want to spin off a United REIT. Else, I don't think there's any catalyst in the near term.
I think they prefer to just keep it to themselves. Especially when this company don't need the cash. Okay.
So whereas OU now, they need to deliver, you see. They need to reach their balance sheet. So I think there is some push. And with the corruption probes, maybe there's really some push that they have to do something about it. And when there's do something about it, there's a chance and there's a catalyst. Right?
Yes, very optimistic way of looking at it. I wanted to ask you also regarding the diversification of these deep value stocks, right? Because you say it's better to have a wider diversification. When we look at investor like Walter Schloss, who he championed and is one of the best deep value investor around, and also maybe even in Singapore, some of the good fund managers who deep value like Aggregate or Human Capital, they tend to own many stocks, right? A few hundreds. That might work for them given that they are a fund, but for individual investors like us, how should we, it's impossible to diversify until such a big wide range, and would you see us just owning like 5 to 10 of these deep value stocks as risky, or do you think we are almost as diversified as the big guys?
Yeah, my view is that should have minimally 15.
Okay. So 15 on the...
So I agree that 5 to 10 is a bit risky for deep value. approach, no?
Right.
Because it's just a statistics game, right?
Yep.
Deep value works, but you don't know what works, which specific stock works right,
Yeah.
beforehand. You only know after that, right? But it's too late if you know after that. So you have to form a portfolio of that deep value, and must have enough sample size per se in order to reap the long-term statistics, right?
Yeah.
Long-term average, right? So if you have too little, it's either you do them well or you underperform very seriously. Yeah.
Cool.
So usually we say minimally 15, 1.5
Right.
in different sector. So you buy Hong Kong land, you buy OUE, there's still property sector. So it's not like
Okay. Cool. Wow, thank you so much for your time today, Alvin. I think I learned a lot, not just on factor-based investing, and of course, I'll definitely go and check out OUE Limited as well. You guys as well, if you have any last question about OUE Limited, if not, do check out the stock that Alvin is talking about. And also, if you want to check out more about Dr. Wealth, you can go to drwealth.com, and I'll share his page up on the screen if you can see it, where he talk more about what is factor-based in investing. I'm not sure if you have the timetable for maybe your next workshop on the website. Would they be able to find that out?
Yep, there is. And actually, I need to have a disclosure, right? We own OUE. So not disclose.
Yes, okay. I think that's assumed. Okay. But okay, anyway, my website is not working very well, but do check out his website at drwealth.com to find out more. That's it from us at Value Invest Asia, the final Facebook Live for 2018. We'll see you guys in 2019. Thank you, Alvin. Cheers.
Thank you, Annie. See you.
See you.